In this video, I want to share with you why credit stacking doesn't work for so many entrepreneurs who are trying this method and what you need to be focused on and looking at in your own business before you apply for another business credit line again. In this video and in our content, all we do is share what's been working for our clients, and we try to pass down some of those lessons over to you here on this channel so you can implement either the entire video in your business or bits and pieces of what you think is going to help you push the needle on the funding that you get so that you don't stay stuck like so many business owners are staying stuck right now in their journey of trying to get access to business capital. Now, if you have no idea what credit stacking is, this is essentially the process of applying for multiple credit cards on the business side across different banks in a short period of time with the goal of obtaining unsecured capital. Now, while this sounds good in theory, this practice often fails for some of the following reasons, which we'll be diving into throughout the video, but I want to give them to you now. Number one is you're probably applying for the right product at the wrong time. Irv, what does that mean? Well, simply put, if your business isn't ready for a business line of credit, we shouldn't be applying for a business line of credit just yet. It's the right product, wrong time. If you're trying to apply for maybe 2 business credit cards, if you're just focused on maybe 0% cards, and you haven't built out your business profile to sustain the weight of those products, right product, wrong timing. Personal credit profile is too thin. I see this a lot. And throughout the video, you'll see me or you'll hear me say personal credit profile or the owner's credit profile. It's essentially one and one the same, again, for the purpose of this video. So when you see me say that, that's why. So the personal credit profile on the owner side is just a little bit too thin. This goes beyond just having a bunch of authorized users on your account. You need to have some primaries built out. And I'm going to share with you more so how we would structure it if you were a client of ours so that you can implement that into your own business. The improper business setup is a big one that I'm seeing, especially right now at the time of this recording. And it goes beyond just having an LLC. We want to make sure that the business is positioned in the marketplace across 3 fronts for the business credit bureaus, which is where these banks and financial institutions are pulling data from, with your bank. So the information is actually congruent inside of the bank because it's going to help out the internal algorithm that they have. And then also if you're into government contracts and government contracting agencies, so you can get some of those bigger deals and some of those bigger contracts, then they are also going to be looking at that data to make sure that your business is actually structured in a way inside of the industry that they actually want to do business with. And then actually, I was going to say lastly, you're opening up too many accounts too quickly is a big pitfall that I see. This is opening up too many business accounts, like actual accounts to put money in, or you're just opening up too many accounts too quickly, meaning you're trying to apply for too many things. And then lastly, of why I'm seeing this method fail more often than not is the information that's being used on the owner's front and business. So we'll coalesce that together is mismatched. This is the name discrepancies, old addresses, old phone numbers, old revenue thresholds. So what's actually reporting on the business credit reports. So I first want to start out with properly positioning your personal credit. Let's set this up because if we don't have this in place first, then we're not going anywhere. Before you apply for another business credit line, whether it's a business credit card, business line of credit, or an SBA loan, which we won't get into in this video, we'll focus a little bit more on business credit cards. You want to ensure that your credit profile on the owner side is structured properly. You don't want to have more than 3 hard inquiries over a 60 or 90-day window when you're going into a round of funding. Now, if you're just coming out of a round of funding, which is what we typically do with clients, 60 to 90-day cadences, you're totally fine, right? Because those are going to start aging a little bit. Those are going to start coming off. But if you're going into a round of funding, that's a little bit too high, especially if you're looking to break past that 50, 100, 150K threshold. You want to have at least 5 accounts, again, from what we're seeing, 5 accounts on the personal side. And these need to be revolving accounts that are bank issued. We're not talking about authorized users, AUs, meaning a card that somebody placed you on. I've read that before. I've said it many times. My dad placed me as an authorized user on one of his cards, helped me boost my credit. But at the end of the day, I still had to go out and get my own credit lines for my own credit profile. I see this all the time when we're bringing on a potential client or when I'm consulting someone and they say, Irv, I have a 750 credit score. And then when we actually take a look at the credit score, it's built out with way too many AUs. That's known as an inflated profile. Banks don't like seeing that. Anything, if I'm going to give you any parting pieces to when you're putting trade lines onto your credit report, anything past 2 or 3 AUs, at that point, you're just going to get diminishing returns. At that point, you want to focus on adding your own personal trade lines that you're physically applying for yourself, not just being added on. Total credit utilization under 20%, ideally under 10%. We have, or they have, I should say, what's called a universal credit utilization and a in-network credit utilization. Let's break that down really quickly. A network or in-network utilization is if I go to Chase and I owe Chase, let's say I already have credit lines with them and I have a 30% utilization, that's known as in-network. A universal means collectively all of my credit lines. So if I have a Chase, a Capital One, and maybe a credit union somewhere, and collectively all of them are sitting at right around 30%, that's known as a universal credit utilization. I bring this up because as we are preparing a profile and a business to go into a round of funding, we don't just want to know what the overall universal utilization is. We also want to know what in-network is, because if we're going to go into a financial institution that they already maybe have a partnership with, and it's something that maybe you want to consider as you're setting yourself up for some funding, if you have over a 50% utilization with that financial institution in-network and you're planning on applying with them, even though you may have 10 or 15% across all of your accounts, you're most likely either going to get denied when you go to apply at that bank, or you're going to get some of those weak limits. And you know exactly what I'm talking about. Like on the personal side, you have a 20K limit on one of your cards, and then all of a sudden you apply for a business credit card and you get approved for like 5K, 10K. It's not supposed to be that way. You're typically always going to get a higher amount on the business side as opposed to what you're getting on the personal side. When it comes to the proper business setup, this is going to be crucial on a couple fronts. Whether you have an LLC, S Corp, or C Corp, I still like to run our clients through this model right here. One of the first things that we're doing when we're onboarding a client is I like to know how many businesses do we have that we're looking to get capital for. Typically, on a 60 to 90 day cadence, we're going to focus on one main business, meaning we're going to focus on one EIN in any given moment. You want to make sure that the EIN that you're using for the business that you have is congruent to the business that you have. Here's what I mean by that. You don't want to have an EIN with LLC 1 if you have multiple businesses, and then you're trying to use that EIN to fund another business. It's known as cross-collateralization. That gets really messy. So we want to use that EIN because the debt that you get is going to follow that EIN, and then you're going to start building out the business credit profile for that specific business. Now, when it comes to the information that you have on that business, I like to take a look at a couple things, but I'll give at least 3 of them to you here. Number 1 is I'm always taking a look at the NEICS code and SIC code, which is how the business is classified. Remember what I said earlier, you're going to get classified in a specific industry and then a subcategory, which is how the banks are going to view you, how government agencies are going to view you, and also how the business credit bureaus are going to view you, which at scale, when you're looking to grow your capital, if this isn't dialed in, that's when you start hitting some of those ceilings that people see. Oh, Irv, I'm stuck at 100K in capital. Irv, I'm stuck at 250K in capital. Irv, I can't get past 500. It's because they've allowed all of this to compound against them. So hopefully if you're catching this early on, then make sure that the key word here is congruency. My information is congruent, meaning it's the same thing everywhere you look. It's the same thing at the banks. It's the same thing at the business credit bureaus. And it's the same thing at the government contracting level as well. Again, if you're in government contracting, because I know that some of you guys check us out. So I want to make sure that I sprinkle that in there for us. Business address, your name and your structure all match across all applications. And then you're ensuring, like keyword, I'm just going to highlight this here, right? You're ensuring that the financial institution and the lender, you're giving them consistent data as to what you actually do in your business. Let's break that down. Irv, like, what does that mean? Simpler. Can you articulate your business to the financial institutions in a way that makes them want to do business with you? For business credit cards, at first, you could probably just do this online, give or take. But with where the economy is moving, especially with banks, they have what's known as know your customer. So KYC, know your customer. They want to know who we're actually extending capital out to. This is why you're starting to see a lot of these financial institutions. You'll probably submit an application online and they'll say, come in person to finish your application. Or if you get a low limit, come in person, let's discuss it. They want to know the customer. So if you can't properly articulate what your business does, thus creating what's known as a lending appetite with them, meaning, hey, yeah, we want to do business with you. Yeah, we want to partner with you. That's when you're going to continue to hit that wall of denials and then just weak baby limits. Application strategy. This is what I would consider, again, this is generic, meaning this is going to be a blanket statement. Is what I'm about to say. So take this and obviously make it your own. Obviously, when we're working with clients, we like to get super detailed because we're taking a look at financials with them, but we're getting detailed as to how much we're actually going to fund the accounts with. But one of the biggest levers you can pull on is increasing your banking partnerships, aka your internal scoring with these banks and with these financial institutions. And so one of the ways that we do this is by adding liquidity, aka cash flow, through the accounts when we're opening them up. So let's say we open an account with Chase, one with Wells Fargo, and then again, one with a credit union. So 3 new accounts as an example. If I have 10K, again, as an example, I'll probably put 4 in one account, 2 in one account, and then the remaining in the other account, another 4 or 3, whatever that number is, right? The reason why I want to do this is because I want to start having an internal log and I want to start building that trust with the financial institution. Liquidity is one of the easiest ways that you can do that outside of how you actually use the capital. So as I am getting ready to go into a funding round, I'm going to deposit funds into that account before I actually apply for something. And then the other thing that I can do is if I already have some type of business product with them, but I'm going maybe for a second or a third product with them, I'm going to use that product. And I want to make sure that they see me using the product and I'm actually paying the card down. I'm using the line of credit, I'm deploying it into my market, and then I'm paying the product down. That's going to create essentially like a network effect because now they see, oh, this business has cash flow coming in and they're also being a responsible customer with the capital that we've given them in the past. It's a bit more high level. If you haven't gotten access to a business credit line yet, then obviously just fund the account. But if you already have a business credit line and you have if you already have a business account, I should say, funded, and you already have a business credit product that you've gotten from them in the past, you can even do this on the personal side, use it. The more data you give them in your favor, the better. I always want to have control over the data that a bank uses for me, not against me. And then lastly, avoid some of these red flags. You want to make sure that your personal and your business data isn't mismatching. So you never want to have a situation where something as petty as you have a 790 credit score, you've been in business for 10 plus years, you're making $500,000 in your business, like you're prime, you're ready to go. And then all of a sudden the bank goes to pull your business credit score and your personal credit score. And then, or they just pull flat out your operating agreements and they see that, wait a minute, when you applied here, you put that your address was XYZ, but on your operating agreement, we see that it's ABC. So which one is it? When I have all of your ducks in a row, I can't tell you how many people get denied simply because they're just not organized. Like the whole point of this is to be organized and have your information congruent. And so if I'm going in, my names match up, my addresses match up, my industry classifications match up on the application, and also any documentation that I give the financial institution as I'm coming in. Avoid submitting inconsistent application numbers. So if I put on one application that I am sitting at 250, but then all of a sudden I speak to another business banker and I make 400, and then I go across the street to the other financial institution. Now my business is generating $1 million and I have 6 employees. Which one is it? It's not just about, put on there that it's $1 million and that your business has 6 employees. That doesn't work. That doesn't work. And if anything, I see people trying some of this stuff, either knowingly or maybe just flat ignorance that they didn't know. And then later on down the road, when they actually go back in and they provide truthful numbers, they get denied or they get their accounts blacklisted simply because there was such a big discrepancy between what you originally brought us and then what you're doing now. And if I could leave you with like one last parting words is this. If you have a third-party company that's like a funding company and they're going to quote unquote do it for you, be super mindful of what's actually being done on the back end. Because if, again, you don't know what they're actually putting on the application, if you don't actually know what they're putting or what they're saying to the algorithm to get that number to quote unquote grow, then again, when you go to actually provide it, let's say later on down the road, a year from today, you say, you know what, I'm going to go in, unknowingly, I'm just going to go into the bank, apply for something as simple as a business credit card today or a business bank account, whatever it is. All of a sudden you put on there that, hey, my business is generating 300K. And they put on there that your business was generating $4 million and you have 7 employees. And it's just literally you and an assistant at 300K. That's awful. I see that happen all the time. So much so beyond the point where it's just, we can't help someone out because they're so deep into what we call like the credit stacking rabbit hole of hell, if you must. But that's essentially it. I wanted to give you this data. If you are planning on credit stacking, more importantly, if you're planning on growing your capital predictably and sustainably, which is what we do here, I don't believe in just trying to go for one product. I don't believe that we should just go for 0% business credit cards, because some of us need capital to be able to deploy into real estate. Some of us need capital to deploy into contracts that we can't swipe our way into. Some of us may need to use maybe an SBA product that we can use to purchase a business. And so that's why I wanted to give you this data. This doc, if you want it, just go ahead and comment, send it down below, and we'll find a way, maybe put it on a page somewhere where you can go ahead and download it and then run yourself through this model. If you want us to take a look at your business, where you're at, where you're looking to go with the capital that you're looking to get access to, we can piece together a funding plan. If it makes sense for you to come on board as a client, we'll let you know what it looks like, what the engagement looks like, and see if we're a good fit to work together and help you fund your business. And more importantly, put a plan into place that allows you to grow your capital as you continue to grow your business. But other than that, I will see you guys in the next video. Bye.